Kraken is going to be forced now to end its crypto staking program in the U.S. and pay a $30 million fine to settle charges from the SEC. The agency said Kraken had failed to register the program whereby investors earn a yield in return for locking up their tokens and allowing them to be used to facilitate transactions on the blockchain. It's the SEC's first crackdown on staking, and joining us right now is SEC Chair Gary Gensler. We should say Bitcoin and pretty much all the cryptocurrencies are down on the back of this news. Chair Gensler, it's great to see you this morning. There's a phrase online where they say, "Tell it to me like I'm 5." So for those who are uninitiated into what happened here, tell it to me like I'm 5. What was Kraken doing, and what was the problem that you were trying to solve?
Andrew, what Kraken was doing was asking the American public for their coins, crypto tokens, and saying, I'll give you a return, 4% to 21% returns. And the problem was they were not disclosing to the investing public the risks that the investing public was entering into. And we have a basic bargain in the United States since the 1930s. You can take whatever risks you want. Companies like Kraken can offer investment contracts and investment schemes, but they have to have full, fair, and truthful disclosure. And this puts the investors who watch your program in a better position. That's our basic bargain. They were not complying with that basic law.
So how does this, though, differ, for example, from some of the other firms out there, including Coinbase, who offer yield products?
Whether you call it, the labels don't matter. Long ago, Supreme Court Justice Marshall said this so eloquently. It's not about the labels. It's about the underlying economics. And this really should put everyone on notice in this marketplace, whether you call it lend, whether you call it earn, whether you call it yield, whether you offer what's called an annual percentage yield, APY, that doesn't matter. If somebody's taking their tokens and transferring it to that platform, the platform controls it. And guess what happens if they go bankrupt? You stand in line at the bankruptcy court. There's a saying in crypto that says, not your keys, not your coins. So those other platforms should take note of this and seek to come into compliance, do the proper disclosures and registration and the like.
Okay, but here's one of the big issues, as I think you know, which is this staking service is going to no longer be available to customers in the U.S. But interestingly, they're going to still offer the same product internationally, abroad, outside of the United States. And so it raises this larger policy question as to whether crypto, these types of products just move offshore. Maybe that's what you want, and that's a good thing. But then whether what you do about the American citizenry who's then using VPNs and all sorts of other things to skirt around what's happening here.
Look, we're technology neutral at the SEC, but we're clearly very focused on investor protection. 330 million Americans are our clients. These firms, Kraken knew how to register. Others know how to register. It's just a form on our website. They can come in, talk to our talented people in disclosure review teams. And if they want to offer staking, we're neutral. Come in, register, because investors need that disclosure. What are you doing with the tokens? Are you trading against the tokens? Are you borrowing against the token? Are you using them for your own purposes? And we've seen this in the crypto field. So investors not only need that disclosure, but it's the law.
Well, let me ask you, talking about clarity, and this is maybe a philosophical, sort of broader policy perspective. I think that there is a common view that your office is using all available means effectively to keep crypto out of the mainstream financial system through enforcement, accounting rules, inspections. Clearly, there's not real guidance yet on custody. And this may very well be a reasonable policy choice, if that's the choice. The question is, if that's the choice, why not just say it publicly?
We're using all available tools. We're talking directly to market participants. We take the meetings. We say, this is how you comply. There's a handful of tokens that have actually registered. the intermediaries, the storefronts, if you wish, the casinos that people are investing in and investing at need to properly comply and disentangle these bundled products. The business model that they've set up is rife with conflicts. And so we've been very candid with them. I've done it in multiple speeches since I came to the agency. We'll continue to engage. We're technology neutral. But if this field has any chance of survival and success, it's time-tested rules and laws to protect the investing public. Disclosure, full, fair, and truthful disclosure. Address conflicts and disaggregate these bundled businesses, and don't have your hand in the customer's pocket using their funds or your own platforms.
But in terms of the larger industry and whether you even seem to suggest the larger industry may or may not survive. One of the pieces of that survival to some degree, I think, has been this idea that one day there may be something like a Bitcoin ETF or something else. Grayscale, as you know, appealing the SEC's Bitcoin ETF decision, which is effectively to say it can't happen. Is there any path at which you think either that specific ETF or something like it could?
The paths, I'm not going to speak about one, but let me generally say, Andrew, the path forward is well trodden. Whether it's large companies that you follow every day, the Apples and other tech companies, or the automobile companies, manufacturing companies, know how to register their offerings. The exchanges like the New York Stock Exchange and NASDAQ and so forth know how to be compliant and come into registration. The big broker dealers and the small, thousands of broker dealers, the mutual funds. I dare go on. We have tens of thousands of registrants that properly, in good faith, comply. They register, they make the proper disclosures. It's time for this group to do so. The runway is getting awfully short, and we're here to try to protect the investing public.
What does stake have to do with our securities laws? That's S-T-A-K-E, not S-T-E-A-K. In the crypto markets, there are various ways to validate data stored on crypto ledgers called blockchains. And one of these ways is called staking. Investors lock up their tokens in escrow and help validate the next block of data. Some stakers are then rewarded with new tokens. Staking, though, can be complicated and time-consuming and can take big upfront commitments of tokens. There's also the risk that you won't get new tokens even if you stake. Thus, crypto entrepreneurs started offering what's called staking as a service. No, not like the steakhouse. Basically, if you transfer your tokens to a staking as a service provider, they take control, possibly pooling your tokens with thousands or millions of others while promoting returns. But here's the rub. When a company or platform offers you these kinds of returns, whether they call their services lending, earn, rewards, APY, or staking, that relationship should come with the protections of the federal securities laws. That means you, the investor, should receive important disclosures. For example, what do they actually do with your tokens? Are they really staking them? Are they lending, borrowing, or trading with them? Are they commingling them with their other businesses? Where do the rewards come from? Are you getting your fair share? Are the underlying crypto protocols genuinely creating value on your investment? Or are they just new tokens that dilute the value of ones you already have? Remember, if you have a stake, that's S-T-E-A-K, if you have a stake meant for two and cut it into 3 pieces, it's still the same amount of stake. Unfortunately, because these staking as a service providers generally are not providing proper disclosures, there's currently no reliable way as an investor to know the answers to these important investment questions. Plus, when you sign on the dotted line or accept the terms of service, you are generally agreeing that placing your tokens with these providers may mean transferring your ownership to them. There's an expression in crypto, not your keys, not your crypto. You see, you're basically an investor in their platform. If it goes under, and we've seen plenty of that recently, you end up in line in the bankruptcy court. That's why it's so important that these companies and platforms comply with the securities law. After all, the securities laws, regardless of what you think of stake or staking, they're good for investors.